Welcome back to Investing Talk Podcast.
Today we're looking at Inno Holdings.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We have a really fascinating company today, Inno Holdings.
Right.
They operate in a pretty niche corner of the construction sector, specifically cold-formed steel framing and prefabricated homes.
Okay, so prefab is the key word there.
It is. And they're not just, sticking to one area. Their projects cover everything from residential to commercial, industrial, and even big infrastructure projects.
Okay, let's unpack this a little. We've been watching the construction space, and the two biggest complaints are always cost and time.
Always.
So Inno's core pitch efficiency, that's got to be pretty compelling right now.
It is. They're not just selling steel beams, they're selling speed.
Yeah.
Their whole model is about using these pre-engineered parts to, slash construction timelines and, really importantly, cut down on waste.
Which is a huge deal on site.
It's a massive deal. I mean, think about the macro problems. The biggest one is the labor shortage. It's crushing the industry.
Yeah.
So any tech that takes work off the construction site and moves it into a factory, well, that's addressing a trillion-dollar problem right there.
It's turning variable skilled labor into something standardized.
Yeah.
Repeatable.
Exactly. And what's really interesting for a company in such a capital-heavy space is just how lean they are.
I saw that. Founded in 2019, and the records show, what, like 4 employees?
About 4 employees, yeah, with primary operations based out of Texas. But, being small and nimble doesn't guarantee success. So the real question is, where's the competitive advantage? What's their moat?
Right. What stops a bigger builder from just copying them?
The moat is their intellectual property. It all comes down to their proprietary cold-formed steel framing technology.
So this isn't just ordering standard steel.
No, not at all. This is specialized engineering. Think of it less like ordering a pile of lumber and more like receiving a perfectly designed, ready-to-assemble kit car.
That's a great way to put it. But why cold-formed steel? Why is that better than, say, traditional I-beams or even just wood framing? What makes it sticky for a developer?
It hits a crucial sweet spot. Traditional steel is super durable, but it's expensive and it's heavy to move around.
The pain to work with.
A huge pain. And wood is cheap, but it lacks durability. Fire, pests, you name it. Cold-formed steel gives you that durability of traditional steel, but because it's engineered with such high precision off-site, it just drastically cuts down the assembly time and cost.
So it's a cost-effective, better alternative.
It really is. So the moat isn't just the material itself, it's the whole process.
The end-to-end service.
Precisely. That's what creates the switching cost. They handle everything from the structural design, the engineering sign-off, the manufacturing, and the delivery. Once a client is in their system, they're locked into a workflow that, a generic supplier just can't replicate.
That sounds like a powerful story for investors.
Yeah.
No doubt. But we have to snap back to the financial reality here, because the balance sheet, it tells a much more turbulent story.
It does. This is the core challenge. The tech story is compelling, but the company's margins are currently negative.
Why? If the tech is so good.
It's the classic early stage problem. They're dealing with high operating expenses to keep that manufacturing capacity going. And maybe more critically, their free cash flow is, it's challenged. They're operating at a startup scale and pouring every single dollar back into R&D.
So perfecting the tech over short-term profits.
Exactly. It's a high-risk, high-reward strategy. They're betting on the long game.
Okay, so if they pull this off, what's the path to cutting costs? How do they get to profitability?
The path is all about scaling that efficiency. The plan seems to be streamlining their production, but also, and this is a fascinating idea, deploying off-site mobile factories.
Well, mobile factories? What does that even mean?
Think of it like a micro-fulfillment center, but for construction parts. If they can manufacture these specialized components closer to the job site, they can cut out huge logistical and shipping costs.
Right, no more shipping massive frames across the country.
Exactly. Shifting from a heavy centralized model to a distributed scalable one, that's the key bet management is making to close that margin gap.
That operational pivot is pretty critical to the whole thesis then, which brings us to capital. Because a weak balance sheet needs some serious moves. And they just made a big one.
A very big and very necessary one. In late December 2025, they did a major capital raise, a private placement that brought in $3.93 million.
That's a crucial lifeline.
It's a huge liquidity injection.
Yeah. But let me push back on that a bit. Is 3.9 million really enough to fund a major expansion in prefab homes? I mean, that's a capital-intensive business, and they're still burning cash. How long does that runway actually last?
That's the right question to ask. And the short answer is probably not for long if the burn rate stays high. But it's about how they use it. The details show they issued 3 million shares at a price of $1.31.
Okay.
And those funds are specifically earmarked for accelerating their prefab home division, which is smart because prefab has the potential for much higher margins than just selling frames.
And I noticed the investors weren't from the U.S.
A small but important detail, yeah. It signals some external confidence, people who see the long-term story despite the current turbulence.
And you can't talk about that $1.31 placement price without talking about what came right before it.
The reverse split, the painful part.
The necessary evil, right? A 1-for-24 reverse split, effective just before Christmas 2025. For anyone listening who's newer to this, can you just explain why a company does this?
Sure. It's usually about survival. The main reason was to get back into compliance with Nasdaq's rules. If your stock trades under $1 for too long, you risk getting delisted.
Which is a death sentence.
It basically is. So a reverse split, while it's never popular, is a stabilization move. It keeps you on the playing field.
So let's look at the mechanics, because the numbers are pretty stark. Before the split, they had, what, almost 98 million shares outstanding?
Right, about 97.9 million, a huge number, which gives it those penny stock optics. The 1-for-24 split slashed that down to about 4.08 million shares.
Okay.
And then you add in the 3 million new shares from the private placement, and the total outstanding is now just over 7 million.
So a much tighter float. Fewer shares out there means each share theoretically carries more weight. It's a consolidation that's, well, it's critical for how the stock is perceived.
Exactly. And that's key because it looks like the market is starting to see past the split. If you look at the chart after December 22nd, despite all that volatility, we saw a recent uptick of over 7% on news of global expansion.
And analysts seem to be reading this not as a sign of failure, but as a necessary cleanup.
A surgical move to create a stable foundation.
Yeah.
If you look at the chart, you're seeing signs of accumulation, higher lows. It's forming a potential base.
And there's that potential for a big bullish signal.
Right, the golden cross. If that 50-day moving average crosses above the 200-day, that would be a very powerful signal that momentum is shifting.
And that private placement at $1.31, that creates a pretty clear floor, doesn't it? A psychological anchor for the market.
It does. It's a hard anchor that analysts are now using to gauge the upside, especially with this new liquidity. So if you tie it all together, sentiment is mixed right now, maybe leaning a little bearish because of the split and the negative margins.
But the $3.93 million is the big bullish counterargument.
It's a powerful one. It shows confidence in management's plan.
Okay, let's talk about the wild card here, the speculative part. There's this Web3 partnership with a firm called Megabyte Solutions.
Yeah, and we should be clear, this is definitely speculative. It's a rumor check, a high-risk, high-reward kind of thing. But construction procurement is, it's notoriously slow and complex.
Just a mess of paperwork and delays.
A total mess. So the idea here is that Web3, using decentralized ledger tech, could streamline all of that.
How so?
Imagine a huge project needing thousands of steel parts. Web3 could allow for transparent, instant, automated payments and order tracking. It could bring a level of efficiency that, the current system of faxes and checks can't even dream of. It's a unique angle.
Very unique. But what's interesting is whether that Web3 thing works or not, the company is still riding some massive tailwinds from the broader economy.
That's the stability element. Construction cyclicals are in a good spot right now for two big reasons. First, the market is expecting interest rate cuts,
which makes borrowing for big projects cheaper.
Exactly. Lower borrowing costs should spike demand for new projects. And second, there's just massive ongoing demand. You've got federal money pouring into infrastructure and this desperate, persistent housing shortage.
So the demand side of the equation is rock solid.
It's never been stronger, which creates a great operating environment for any company that can promise to build faster and cheaper.
But even with those tailwinds, we have to come back to the bear case. What's the biggest risk still on the table?
The risk is still dilution. The 1-for-24 split and the 3 million share issuance, that raised red flags. Investors are rightly concerned about the company's ongoing need for capital.
Even if it was kind of priced in?
You could argue it was priced in when the stock was trading around 11 cents, yeah. But it's still a material change to the float that you have to watch closely.
So with all this complexity, the tech, the cash, the split. What's the catalyst calendar look like for the next, say, 3 to 6 months?
The first thing to watch is the full closing of that private placement. That should happen mid-January 2026. That's when the cash is actually in the bank.
Step 1. Step 2 is what they do with it.
Exactly. The real focus will be the next quarterly earnings report. After that last 10Q in July, everyone will be watching for revenue acceleration. We need to see that the $3.93 million is actually being used to grow that higher margin prefab business.
That's the litmus test.
That is the test for the whole turnaround story.
Okay, so to sum it all up, this is a high-risk turnaround play. You're betting on their proprietary steel tech and this big liquidity boost to fund an expansion into prefab homes. The time frame you're really watching is this next 3 to 6 month window, leading into those Q1 2026 earnings.
That's right. It's a classic battle between huge innovation potential. This tech could solve a massive industry problem, and the execution risk. You have negative margins and a management team that has to prove they can scale quickly. Hopefully, the knowledge you've gained today helps you weigh whether that $3.93 million is a real bridge to profitability or just a temporary fix. Make sure you subscribe to the podcast so you don't miss our next analysis.